Now I will be talking about chapter 12 of CFA Investment Management Certificate. This chapter says about establishing and qualify a client objective, because when you conduct client investment, we need to know a client objective should be specified in financial terms and should clearly state how much is needed and when. In other words, must make a real forecast over the client's life, as the life have up and down. So you have to take everything into consideration. Let's assume if an investor say that he wants to save for his retirement, any proposed solution should take both account the terms and interpretation income in his retirement. Some of the events that we have to look at are the illness, in case the investor fall down, get sick, so he likely to need these funds to support himself if he gets sick, or spend in a hospital or care or many other expenses which come unexpectedly. And the other is the death. In case of death, he nominates normally his wife or his children. Therefore, a financial protection is necessary. Establishing affordability that can be establishing by prepare a cash flow showing all possible expenses and the probability of deficit. Deficit is when his expenses is higher than his income. So now and again problems come about, and then may likely to withdraw part of his funds. So all along you should have look at it, look it very care at the smooth in a stream that does not disappoint the investor in the end of his pension scheme or investment when he gets retired anyway. As far as he pay all along and get what he really want to achieve. In this time, in the longer run, many other incidents can come about. At the same time, he can take part of these funds to support his expenses. The client current circumstance. First of all, you need to look at. We need to collect hard facts, which is his name, date of birth, marital status, his address, his employment, whether he's self-employed or employee, and then all about his financial situation. and whether he's got saving account, mortgage, or loan, credit card balance, pensions, and the other liabilities. We'll also need from the client the letter of authority. The letter of authorities give to the fund manager the power to collect further information about the client financial situation, because sometimes the clients are not able to provide all information necessary that concern to build up all information for cash flow. Cash flow is you're gonna build up a cash flow based on the current life situation of the client, and then see all possibilities of high expenses, as I said, deficit, sometimes it's a superavit when his income is higher than expense. Thus, he can spend or keep for rainy days outside of the investment. We need to see if there is a possibility of extend mortgage, loan, or any other liability. We also have to collect soft facts. Soft fact, this involves asking the client how comfortable he feels about the spread of the investment that he's engaging in. Because sometimes a person wants to buy other property or a car or other house or house abroad. At the same time, he's got the option of investing in financial market. So the client must be very comfortable with the situation, because he can, if he changes his mind after 6 months or a year, and he wants to get all his funds back, withdraw, probably he's gonna withdraw less than the amount that he invested in, because when he investing as a fee, as a contract, that's transference of equity or whatever equity or share that he buys. Only initially has expenses that does not bring the return in a very short term. So the client must be very comfortable and aware about what he is doing. Under section 3 of chapter 12, we show different facets of investment risk. Most private individuals understand the investment risk, but they focus only on the risk long term, which the investment much worth less in the future than it worth today. That's called capital risk. So you put the money in such investment, if you put inflation into consideration and many others assets in the market that could be in higher valuation than the others, but no one can predict. So all this consideration make part of capital risk. Nowadays we don't know what is the world will be in 10 years time. This is because the factor that affect the future value, we call it inflation, which is unpredictable. Let's assume if an investor has a gross income of 5% of the whole investment, and he does pay 20% of tax on top of those 5% gross. If he does pay 20%, he's gonna get 4% net. If the inflation is anything above 4%, he is running at loss. He's losing money. He's losing funds because the inflation is higher than his net income. The investment becomes worthless because he's taking less money than he was expecting. The Monetary Policy Committee (MPC) of the Bank of England is responsible to set the interest rate that must be above the inflation. The rate was below the inflation in 2008. As the result of it, the investment had shortfall risk, so the investor received less than what they were expecting, and to achieve what they wanted to do, it had to increase the amount to invest or lengthen terms, so take more time to get the funds that they were expecting. The diversification to suit the client's objective. As we have described, the risk related to inflation and lengthen the terms to achieve a certain outcome. The diversified portfolio at aggregate level can reduce the risk of the investment because we assess the risk, what can go up or it can down, but combined with other shares which oscillate or change or have their rate averse or different level, different rate, which minimize the risk of the investment. Probably the return is lower, but also the risk. Need to make a time scale of the investment. Let's assume a person will be retired in 30 years time, and I'll just invest the whole money in equity in order to avoid shortfall risk. He doesn't want to have a shortfall risk, so put the money in equity. But let's assume in 3 years time, this person need to withdraw funds to cover some unexpected expenses. So he end up in a loan or borrow, which is gonna pay interest for that loan in a higher than he invested, because always the short terms has a higher interest. So you need to diversify. If you diversify in a portfolio, put some short terms, the other ones in the long terms. So those ones in short terms, he can short it, sell it to accomplish what he needs to. So it's necessary have in a portfolio long term and short term in case if you need funds, you get those short term and sell off. Need also determine the client's attitude to risk. There are two ways to identify the client's attitude to risk. If the client has already got a portfolio or investment that it has been declining in value due to fall in the market, one can be comfortable with the situation and wait for improvement in the economy and in the market. Other ones who does not support or go paranoid because think it's gonna lose the whole money. So the fund manager must find out alternative to transfer his investment into other investment which show safety to his client. In the section 4, everything that the professional investment have to report back to client with recommendation. There are a huge number of different investments that a number of clients and the others professional can swap around, but it's crucial to make a report to the client, making the client aware about everything is running with his money, his funds. Keep the client aware and be able to keep up with the movement of the shares. Well, this is described properly on the chapter 7. If you see the video on the chapter 7, it describes more accurately. In this, and then you said asset allocation strategy. This asset allocation is a mix of underlying asset classes held within investment portfolios. So each asset class behaves differently with their very different risk profiles. That's I have just said, as I mentioned, when you have a different class of shares in the same portfolio, they combine the risk. When one shares go high, the other one comes down, so minimize the risk. That's why if you allocate the assets in different classes, you minimize and they make the investment consistent. And you also the fund selection process. First, we know the client's power decision, because some investors cannot make a decision on his own. Sometimes they depend to third party. He's not the single person to make decision. Narrow or wide selection, we need to take consideration of what can be taken into account. One of the important indications can be past performance that show how that particular asset behaves, the past and the history of that asset. If you put in a line over 2 years or 3 years, you see how that share value develop. And they also look at the segment, which sector that shares make part. Sometimes if some other company take over the others, the one that is being taken over are likely to have their share appreciated. Also, look at the charge. Normally there are two main types of charge. The charge is when you buy a share or when you sell, there's a charge. And also there's a annual management charge that is charged in the life of the investment, because professional investment, as they look after investment, have their fee. And the financial stability of the providers, the rate of bonuses passed on to investors is not directly related to the performance of the underlying managed funds. They do that in order to minimize their expense, because let's assume if the shares goes up and at the same time the share issuer have other plans with those funds to plow back in the activity, so they cannot pay in one go for the investors. That's why they pay in smoothly way, pay dividends in order to reduce the payment eventually. The benchmarks and the reviews, clients will be interested in how the investment performing, which can be measured in terms of absolute return, but is more meaningful when compared to some benchmark. This means compare performance of another similar investment, an unbiased benchmark that comprises similar investment types, reviews an opportunity to change to their circumstance and the objective with long term. Monitor investment performance ideally against the benchmark. Sometimes wondering, is the portfolio outperforming the relevant market, or it should some of the investment or fund be changed? So rebalancing the portfolio in line with the agreed asset location. So all the time you need, the investor has to keep up with the share, and the investment professional must look at the portfolio all along in order to run the portfolio healthy and never bring a loss and the disappointment to their client.